Hello, welcome to Legacy Private Trust Company's Market Update, May 2021. My name is Peter Schaefer. I'm a portfolio manager with Legacy Private Trust. And what I want to do today is take a couple of minutes, talk about three main things that we at Legacy are looking at in terms of the market: the virus, the economy, and clearly the markets themselves, both equity and fixed income markets. The first thing to touch on whenever we talk about the virus is an update on vaccinations. We have two pieces of data here. One is from the CDC on the right. Currently, we are administering 2.7 million doses of the vaccine every single day. Currently, we have 45% of the US with at least one dose of vaccine administered. Almost a third of the population, 32% of the US population, has been fully vaccinated. So the US, we are obviously doing very, very well on the vaccine rollout. The chart on the left is courtesy of JP Morgan Asset Management. This lists us compared to a few other countries. Now, even though the US is doing great, we're actually not the best here in the world. That would go to the UK. Roughly 50% of their population has had at least one dose of the vaccine. If you look at other countries doing very well, Germany, France, in addition to the US and UK, well, those are developed countries. Developed countries have stronger healthcare infrastructure. They're rolling out the vaccine better. We're starting to see emerging markets lag behind. As emerging markets started off the year very strongly, we're starting to see a divergence. Developed countries are doing better in terms of equity market returns, as well as vaccinations. We think looking forward, these developed countries actually have a better opportunity to outperform, specifically because their economy is going to reopen faster. Now, if we take a look at the US a little bit more specifically, two pieces of data that I find really interesting. On the left-hand side, we have card present transactions. Those are point of sale credit card purchases. So not Amazon sitting at home, logging online and trying to make a few purchases. This is actually in the store swiping the card. Going back to pre-pandemic levels and into the pandemic, we saw a 70% decline on in-person transactions. That's a staggering amount. Since then, we have seen that number continue to get better, specifically because vaccines continue to roll out. We're seeing consumers be more comfortable making purchases. That's really important because we had fiscal stimulus really pushing the economy forward. But we can't always have massive fiscal stimulus. We need to have consumers take the lead. And it looks like they're starting to. On the right-hand side is lodging. Think travel and leisure, the sector that was hit hardest through the pandemic. Now, lodging transactions pre-pandemic into the pandemic was down over 100%. Now you think, how could something be down over 100%? Well, it's very easy. Not only were hotels not making reservations, they were refunding a lot of previous money that was already made. As we've seen through summer, through winter, and through today, we're seeing lodging is down only about 20% from where it was last year. Again, a third of the population has been fully vaccinated. As vaccines continue to roll out, we expect this number to get quite a bit better throughout the rest of this year. Now, the other side of travel and leisure, aside from hotels, is airline. You think going back to the pandemic, one of the last places you wanted to be was a hotel. Well, you really didn't want to be stuck in an airplane. If we go back to March 1st of 2020, 2.28 million travelers went through TSA in a single day. Move forward about 5 weeks to April 12th, barely 90,000 travelers went through TSA. That's a staggering decline. Now, what has pushed these TSA numbers back? Well, vaccinations. You can see the orange line, number of doses of vaccines administered. We've administered about 235 million doses of vaccines. That has really made travelers much more comfortable getting back on airplanes. Again, we think that's going to help that travel and leisure sector. We think that's going to help the economy reopen. Now, the other side of travel and leisure, let's go on the total other end of the spectrum. Let's look at manufacturing. This is a global heat map of the Purchasing Managers Index. Essentially what this is, it's a survey of the 400 largest companies in all these countries, and it's very simple. Are you buying inputs to make outputs? Boeing, are you buying steel to make airplanes? Now what we're seeing right now is we're seeing expansions. If you look at the numbers on the bottom of the screen, if you're over 50, it's an expansion. If you're under 50, it's a contraction. So very simply, when you look at this chart, you want to see a lot of green. And that's what we're seeing. The US and the UK, two countries leading the way on vaccinations, have very strong manufacturing. We would expect this. This is very much a confirmation indicator, makes us feel quite a bit better about the global economy reopening. The other thing to think about too is inflation. As inputs are increasing, and ask anybody that is building a home right now, lumber prices are through the roof. These inputs are becoming more and more expensive. Well, even though these inputs are becoming more expensive, we are still seeing manufacturing companies buy these inputs to create outputs. This is a very promising sign for the global economy. The one thing it's not a promising sign for are fixed income and yields. As I just touched on, inflation is starting to increase. As inflation is increasing, we're seeing bonds sell off. If we think prices are going to go up in the future, well, we don't want to lock in that guaranteed return from fixed income. As a result, we see the 10-year yield here in the US is 1.62%. That's up 0.75% just from this year alone. Fixed income is not attractive right now. And if we go back to a video that we did in January, we made that case. We said fixed income is not attractive, equity markets are a little bit more attractive. So if we look at equity market performance this year up to April 26th, we actually see just that. And the key takeaway from this slide is if you look at energy and financials, two sectors that really underperformed last year are performing very strongly this year. The reason why, as economies begin to reopen, we're seeing more travel, which impacts energy. We're seeing interest rates come up, which impacts financials. We're seeing these reopening trades tend to do very well. Now on the right-hand side, we have four different indices, just generally the S&P 500, the Russell 2000 are small cap, small companies, developed, foreign, and emerging markets. Just like last year, finishing the year, no matter where you were invested, you did pretty well. We're seeing a very strong equity market performance this year. The S&P 500 is up 12%. Small cap actually leading the way, and you would expect that coming out of a recession, up 16.5%. Foreign equities developed up 8.6, emerging markets up about 6.6. We're starting to see that divergence. As developed economies continue to roll out the vaccine in a much more efficient manner than emerging markets, we're going to see that move through in equity market performance. Now, when we take a look at the US markets, we say, well, how can the US markets continue to move higher? Price to earnings multiples are extremely high. Well, the main point is, think about that excess dry powder on the sidelines. All of that fiscal stimulus that didn't move into purchasing, well, went into bank accounts and savings accounts and money market funds. If we look at money market fund assets, as of at the end of January, there was $4.3 trillion of dry powder on the sidelines. The two prior peaks, January of 09, 3.8 trillion, January of 03, 2.3 trillion. Now, history doesn't repeat itself, but it often rhymes. If we look at 3-year US stock performance following those peaks, well, going back to 2003, we saw equity markets average 16.4% every year for the next 3 years. In January of 09, 19.2% market performance averaging over the next 3 years. We still feel good about equity markets churning higher. Yes, multiples are very expensive, but as we look at all that dry powder on the sidelines, well, eventually we think that's going to flow into equity markets. And in fact, it already has started to. If we look at the first quarter of 2021, we saw $334 billion move into equity markets. That is higher than the next two highest quarters combined, 2013 and 2018. Now, actually, if you look at 2013, they're actually on this list 3 times. Quarter 4, quarter 2. They had a lot of equity inflows into the global equity markets. Those are good years for the market. So we don't think that this has ran too far too fast. We do not think this is a bubble. We think that money is just finding a good place to go where it can get some attractive long-term returns. Something we feel very comfortable with. Now, I do want to make one comment. As last year ended up being an incredibly strong year for the equity markets, for the whole calendar year, the S&P 500 was up 18.4%. Over the last 12 months, well, since the market low of March 23rd, the S&P 500 is up about 75%. We have had an amazing rally since that market low. I do want to temper expectations a little bit. Now, this chart is from Ned Davis Research, and what they did is they looked at all of the bull markets we've had. They looked at the initial return of that first year. They compared it to the second year. Roughly 80% of the time, the market has underperformed in the second year compared to the first year. We still think equities can continue to churn higher in the second year. In fact, they already have. The S&P 500 is up double digits. Small cap is up double digits. Foreign markets are on the way there. They're not there yet, but we think they could get there. But we don't think it's going to be some amazing return like we had last year. So we do think we want to temper expectations. I think the word here is choppy. I think we might have a choppier finish to the year. So expect volatility. And I think it's important that you hear us say that as portfolio managers. We think there's going to be volatility in the market. We are anticipating it. So just be ready for it. Again, with all of the economic data behind us, we still feel very comfortable with equities. So if we look at, again, those 3 main things that we're looking at, the virus, vaccines continue to roll out. US, as you would expect, is one of the leading countries rolling the vaccinations out. Roughly 32% of the US has been fully vaccinated. We're seeing increases in in-present card transactions, travel, and leisure. In terms of the economy, we're seeing manufacturing pick up as would be expected, even with inflation. Continuing to see growth in manufacturing. That's very good. Within markets, within fixed income, we still think it has a place in portfolios to play defense. But we think looking forward, the majority of that return is going to be found in equity markets. Now, if you would like more information on Legacy Private Trust Company or what I reviewed in this webinar, please contact marketing@lptrust.com. Thank you.